Good morning. It's Friday. Welcome to the Brew. And you know what that means. On Friday, we have our great guest from CNBC, Paulina Likos. We're going to talk about some of the news events this week and dive deep into them. So let's get started with Paulina. Hey, happy Friday, ladies. How are you? Paulina, good to see you again.
Lex.
Molly?
Good to see you,
Lex.
I know. So I just realized this. I wasn't part of the show last Friday. I was away. You guys did great. I loved it. You guys are going to kick me off. I feel it coming. You're going to give me an email. Sorry to have to tell you this.
Paulina's backup dancer. That's all that is.
We all have great discussion.
Oh, that's good. Very good. Paulina, how are you? How was the week? Pretty good?
Yeah, I'm doing really well. The week was busy, but it was an exciting time for the markets. We had the Federal Reserve, we had more IPOs, and we're going to discuss all of that today.
Okay, good. Molly, you're doing well too, I hope. I noticed we're still on the black theme.
I want to make a comment on your swag, on your Tradier Hub swag. I'm loving it.
Check my shirt out. I don't know what it says, but it's kind of cool. It's got a back to it too, so. Yeah, I know. I got the hat that I can't bend, so I got to kind of turn it a little bit like that. And I'm keeping the sticker on too.
I feel like you're bringing that sticker back. That's
such a kid at heart.
I know.
All
the
right.
paparazzi's all going to start wearing gray T-shirts. Watch the world.
Very good. Okay, Pauline, let's let you have at it. So, what are we chatting about first? What's the big news event? I know there's a couple good ones out there at least.
Yeah, there's a few. I think one that has been going on for a few weeks now is the UAW strike, the United Auto Workers strike. That has really been top of mind for investors that are, investing in the three big Detroit automakers. And the president of the UAW, Shawn Fain, he said that if there isn't any progress made on these contract negotiations, then there's going to be even more strikes. I actually read this morning that it's possible the strikes could last until November, which is pretty devastating for these automakers. But I wanted to kind of break down what this could mean for the automakers, for the economy, and for investors.
Mm-hmm.
So basically, the UAW strikes have really been weighing on the three companies. Which three companies? Ford, GM, and Stellantis. And it could also have an impact on the economy. So Shawn Fain, he is really playing hardball here with the union demands. I would call these demands high stakes negotiations between the unions and the automakers, because he is looking for higher wages, increased benefits, and all this is going to be more costly to the car companies. It's also important to remember that the automakers are in the midst of building out their electric vehicle businesses, and that requires not only a lot of capital investment, but workers are also needed to put the EVs together. So when you have this ongoing strike, the output is not only going to be impacted on EVs, but also other vehicles could be delayed. And that is going to have a ripple effect across the industry. So what are the impacts there? First and foremost, it's going to increase the price of vehicles, both new and used vehicles. On top of that, you have higher prices at the pump. They reached almost, I think they crossed over $100 per barrel this week. So ultimately, it's important for there to be an agreement between the union and the car makers sometime soon, because the companies need to get back on track in terms of putting these vehicles together, but also for the shareholders, so there's no more volatility in these stocks, and the shareholders don't suffer from these beaten down prices.
Okay. So sorry for this, but Stellantis, what is that? I've never heard of that. Is that a car maker?
Yeah, I think they make the Chrysler.
Oh.
Yeah.
So Stellantis bought, it's a big unit that bought a familiar name, Chrysler.
Correct.
How am I doing? I haven't seen a Stellantis on the road is what I'm getting at.
Right.
I don't even know what that is. I'm like, oh, I don't know this. Okay, so go ahead. Sorry, Paulina, were you going to say something?
No, I was going to ask you. Go ahead, Lex.
No, you go ahead, Mal. Go.
Yeah, I was going to ask a question. So, what you bring up a really good point. So, we have these companies are getting. So, yes, when you hear labor unions, and by the way, there's always been an uptick. You know, if you look at COVID, it was kind of like a global war just against a virus, and there's a lot of stuff going on with that. But we're going to park that. But there's always been an uptick after a war of labor arguments. So after World War I, World War II, now this. So we also, you know, I'm in Hollywood. We have Hollywood strikes going on. We I want to make sure that, you know, especially with inflation, those adjustments have to come out, but also always looking at also the full picture. So what do the companies go through? And you just mentioned there's you know, with inflation, they are also feeling inflation with you know, interest rates going up. It's hard for them to get capital, harder for them to grab cash on hand. And also now, you know, if those expenses increase, it's like this trifecta of pressure. What do you see on your side?
Yeah, I would say that when there's increased wages, obviously that is it's not going to be good for inflation. And when we think about the Federal Reserve and how they're shaping their monetary policy, they're trying to keep that labor component at bay, because if wages keep increasing, then that's going to further put pressure on inflation. And we know that the whole point of the Federal Reserve increasing interest rates is to tame inflation and bring it down. It has decelerated throughout the past year. It recently has accelerated. So, you know, if these we'll likely see some sort of increase of wages for these union workers. And that is obviously going to go against the Fed's narrative of keeping higher wages at bay.
Mm-hmm. Okay.
And I suppose we probably have to add the component where there's been a lot of QE, you know, a lot of money being put into the system. So I think it's probably increased by now, but 80% of current currency in circulation was introduced to the world and into the US in the last couple of years alone. So perhaps maybe I'd like to dive deeper maybe on another show of the access of that capital and where is that sitting, and to weigh that against these labor strikes and inflation, buying power, and those components. It'd be nice to see where's the money. So, you know, these people are having a hard time paying for their bills, but also corporations, I have company, and you work for, we know the hardship that it takes to run a company. And so they're like their own little entities in themselves. So always to make sure that we always hear both sides of the story, and also, you know, remain concerned for the everyday person who's just trying to put food on the table.
Yep. So the other thing too, Paulina, you know, this isn't the first UAW strike we've ever seen, right? There's a history of these. How does this one end? Are the makers going to concede, or they're probably going to meet in the middle? I get that. But my question, you know, who's paying for this? We are. Exactly. We're going to pay for it. It's going to be higher prices, as you said, and GM and the gang are going to pass that along because they have to now pay higher stuff. Is that going to be the end solution here, do you think, or is there some little trick in the box that we're missing?
Well, there's different ways you can look at it. First, the tough reality is consumers have gotten used to paying higher prices in a post-pandemic world, where companies have had pricing power. Some companies where they've been able to increase the value of their goods and services without too much pushback. So that hasn't really been going away. And you know, consumers, they have been seeing an increase in wages. However, that increase is not accelerating at the same pace as inflation. So even though consumers are still paying higher prices and there's not much of a pushback on those higher prices, they're still feeling the pain because their dollar is worth less than it was just a few years ago.
Right.
But going back to the three automakers, 2 points here. First, I think Ford is going to be kind of the best position out of the three because they have a good relationship with the unions, and the negotiations between the UAW and Ford have been pretty positive, versus for GMs and Stellantis, it hasn't really been going in that much of a positive direction. And more broadly, who is the winner here out of all of these car companies? And that is Tesla. Tesla is the winner here because they don't have any association with the unions. And if I'm not mistaken, I haven't seen Tesla's stock price, but I think it's been faring much better than the legacy automakers.
Yeah. Yeah, that's a great point. I was going to ask you about Tesla too here. So they've avoided the whole union game altogether, right?
Yes.
Yeah, and I pulled up a chart of GM. So it's at, a year chart. It's well toward its lows over the past year. It looks like a sine curve on the chart. But my other interest too with all this is I was wondering if, and again, this is getting to the weeds a little bit from my angle. I look at implied volatility of the options, right? And I know I'm not going to ask you a question about that. Don't worry. And implied volatility is not terribly high in General Motors. I haven't looked at Ford yet, but I thought maybe with this looming out there could be some sort of larger move potentially in the underlying, which would cause implied volatility to be a little higher, but it's not indicating that at all. So maybe that's a sign that this thing's going to come to an end peacefully somehow. I don't know. So
hopefully, these strikes can't last forever, and ultimately, I know even President Biden, he wants a resolution. So I think there are multiple parties that are coming together to try to make something happen. So I think it's everyone's hope that these strikes and negotiations are going to come to an end soon.
Okay, good. Couple more topics on the sheet today, right? So, and I know we're tight on time. Fed paused Fed interest rates.
Yes.
So they came out and said they're pausing. However, there was some verbiage beyond that about the future, and that's what caused the market to get a little skittish yesterday, I guess. So any thoughts there?
Yeah, so the Fed had indicated that there's going to be at least one more rate hike this year. There are those who believe the Fed just should have raised rates this week so the market could have digested and we could just move on. Like I said earlier, inflation has come down, but it has recently reaccelerated, and that has been really hurting the consumer and putting pressure on their spending. I think the most important takeaway from the Fed week, though, is that Fed officials expect rates to stay higher for longer. And the impact here is that it's troublesome for companies and individuals alike because higher interest rates means the cost of capital is more expensive. And by doing this, the Fed is trying to slow down economic growth, which has given rise to that stubborn inflation that we just can't seem to get down to the Fed's 2% target. And ultimately, I think the consumer is bearing the brunt of all of this. And I've seen a bunch of different surveys as we head into the holiday season that show that consumers are planning on cutting back on spending towards the back half of this year as it relates to holiday purchases and so forth. So that's kind of what came out of the Fed and what the implications may be for companies and individuals.
And tying these stubborn higher interest rates back to this UAW issue, I can't even imagine what a car costs now, current interest rates versus a year or so ago. I haven't been in the market, but I'm getting in the market soon. So I got to believe my interest costs, if I'm going to use a lease or something, they're going to be crazy, right?
Right. So that's not only is the actual car itself expensive, but when people buy cars, they mostly majority buy it with debt. And so when that interest rate goes up, you're almost buying like two cars when that interest rate doubles. So it does get expensive from that component. And then the monthly cash flow on that is higher. And It's just, I just want to point out that, it's me. So I just want to point out that when the Fed, talks about interest rates and, raising or lowering, we always have to remember what is the bigger picture. So government writes, takes a piece of paper, draws colors around it, and writes bond on it, and then hands that to the Fed so that they have an asset to then balance that liability of. Then the Fed takes another piece of paper and writes a check that isn't backed by anything and gives that back to the government. So really, it's a hidden form of taxation. It's a lot easier for politicians to do that methodology than increase taxes. Increasing taxes is political suicide. So with these interest rates going up and down, and what is the Fed, and I just want to make sure that people do their research when they get home and understand how the Fed works and how does QE actually play out, because really they're putting money into the system, and like Lex said, we will end up paying in our buying power. We may not be paying taxes, although we do. A lot of the taxes go to paying that interest, but we want to make sure that we know the whole process, and we don't just look at the Fed behind some nebulous, we don't understand how it works. It's actually quite simple if you just do a little bit of research to understand that weird, strange exchange. What do you think, Paulina?
Yeah, I think the Federal Reserve has been an increasingly important entity in the monetary world. And unfortunately, we talk about it way too much in business news. And I think that's ultimately a bad thing. I think it's bad that the markets are so much dependent on the Federal Reserve instead of having, the natural, dynamics of the market kind of take over and work for itself.
Yeah,
No,
I
no,
agree.
go.
And to clarify, the Federal Reserve is not federal, and since 2020, I believe it was 2020, there is no longer a reserve. So if you just go on Wikipedia, Federal Reserve, the reserve says zero. What that means is that there doesn't need to be anything in the bank now. So we are officially went from fractional currency all the way over. We're 100% fiat, and that is a ticking time bomb. So, but we can't take the debt out of the system because the debt is the monetary system. So that is another topic for another day. But just do your research when you go home, because knowledge is power. It's really great.
Yep. I think Paulina has to run. Am I right about that? Because you had a couple more things on IPOs that are out there in the market. I was just kind of reading a little bit about some of the ones that are coming out. Maybe we tackle that next time, because I think you have to cut, right, Paulina?
Yeah, sure. I just think, symbolically, I'll leave by saying this: for IPOs, there has been, major tech firms that have been, going public, that have been breaking the IPO drought. And, some of them have been, the sentiment around it has been positive. The companies, though, have been a bit volatile because in their debut, they have fewer shares that are available. So yeah. Even though there has been, positivity around the debuts, and we did kind of talk about this last week, how it might not be prudent for investors to kind of buy shares when they first go public, rather wait and see how those stocks digest after they go public, because there's just so many price swings.
Right.
That's good advice. And Pauline, can you say, when you limit shares on an IPO, that it's kind of like Studio 54? You have a line outside, but they won't let anyone in on opening day.
Studio 54 analogy. I love it.
I digress.
Never wait behind the velvet ropes. Find a way in.
Find a way in. Yeah. Pre-IPO investment.
There you go.
You have to go through the back door.
Very funny. All right, Paulina, thanks as always.
Thanks, Paulina.
Good to see you.
We'll
see you next Friday. So you have a great weekend and a great week, and we'll talk next Friday.
Thanks, you too. Talk to you guys next week.
Okay.
Bye.
Oops.
Yeah, UAW is is it the largest labor union in the United States. Is that
I don't
correct?
know. I don't follow labor unions very well.
I know they're complicated. I think
Yeah.
I've been learning about them being in Hollywood, and
Yeah. You have a
it's
big
really
strike out
interesting.
there too.
Yeah, we have a huge strike out here, and there was a great analogy where if you're playing for the big leagues, and so
Mhm.
SAG is the one that we're looking at for the labor union. So if you're playing
Right.
for the big leagues and you're an actor, and um, they aren't negotiating, so they're trying to, choke out SAG. So SAG is saying, okay, well, we'll release movies that fit our requirements. And
Mhm.
so an actress said it was really interesting. It's if you're paying for the big leagues, then but the minor leagues just decide to pay more, then everyone's going to go over and play for the minor leagues
Right.
because the contracts are better.
Right.
So,
Um,
but
yeah. So yeah, I don't know. These strikes are interesting. I just, at the end of the day, like I said earlier, we're going to pay for it. So it's all there is
we
to it.
are, and I would love for all members of unions to, while they're at home and they're out of work, to really study, get into companies, get into. I mean, if people are on strike, it's really great to, and their income is now pulled out from underneath them. What a great plan B is to trade. If you're at
Ooh.
home, start to study. Yeah, start to study trading, and then you'll start to understand when you research companies you're investing what they're up against. Because
Right.
a lot of time these unions, eh, you know, they don't share the whole story of what it takes to run a business and to employ people and to make sure. And they also have a lot of regulation that gets
Right.
expensive. They have to fall under. And with Sarbanes-Oxley, back in my day, a lot of companies went out of business because they just couldn't afford the fees to keep up with regulation. And
Same
so
with
there's a
me.
lot of
We
other
stopped doing it.
components.
We stopped trading because, as a firm, because of the regulations. That's
Really?
caused.
There,
Yeah,
yeah,
it was a one size fits all. But that's for another day, I suppose. One
that would
last
be good.
point I want to make
Yeah,
about weave and options trading here. How's that sound? You
I love
ready?
it. Yeah,
Okay.
because here's why. Give us the action. Give us the
Well,
action,
here's
the
what
call to
as
action.
Paulina was talking and we were asking her questions, I was looking at some of the, I told you, implied volatilities.
Yeah.
And I was looking at GM and Ford. I don't know what Stellantis is. I still don't. I can't find a ticker on it, but who knows? But the implied volatility of both those stocks is very low. Okay, relatively speaking, it's very low. So I would think there would be a little bit more volatility if there's that much sort of chance of turmoil, with the strike and what have you. But it doesn't seem like that. The other thing, so my strategy there is right now is to do nothing, just so we're clear. And remember,
Okay.
I told you that a long time ago
So
on one
by
of
the way,
our
I love
FBs.
this. I wrote this
Sometimes
on
the
my
best
list.
trade is no trade, right? So you
Yeah.
don't want to force things if you don't have to.
Let's say that again, Lex. Give us that piece of advice again, because
Sometimes
that's the
the
gold.
best trade is no trade.
I
Okay,
love it.
snip that baby. We got to snip that one. Get it out there. Okay. The other thing that's really, really challenging for the market making community is these IPOs. Because what happens in an IPO is it's a brand new stock, never traded before. Instacart's coming out, or it's come out, right? Stripe was out there, I think. They're talking about that one. Databricks, ARM, you guys talked about. Instacart, I said. Discord, all multi-billion-dollar companies. So when they list these stocks and then all of a sudden there's options, which is a derivative of the underlying on these stocks, someone has to make a market in those options, right? That was usually someone like myself in the market making community. Now, how do you make a market in something that's never traded before? How do you know which implied volatility to put, right?
Right.
So it's a little tricky. And what the community did during my time was we tried to find like companies, okay, to the company that's IPOing, and then look at the implied volatility surface and matrix in that like company, imply, a similar kind of implied volatility to the new company. Now,
Interesting.
it can be sometimes a game of trial and error. So that if it's one-sided, so everyone's buying options from you, your implied volatility is too low. So what happens? Everyone raises implied volatility, right? So there's a little bit of this feel the wind in the game. Now, I'm sure these big firms like Citadel nowadays, they're They totally have this great economic and statistical model that they use. Plug it in and spit out. Here's what it should be to start. Let's play here. So I'm sure it's gotten way more scientific nowadays, though. Yeah, you were going to say.
As a market maker, from the day it goes public, when do you start to what's the timeline of developing a full?
There is actually a some sort of rule, and I don't know. We'll look that up for next time. But there is a rule that I think it's from the either FINRA or SEC that once it's IPO'd, it's got to trade for N number of days, weeks, months. I can't remember what it is before you can start before options can be listed on it.
And why is that?
There's a time period, and I don't know what it is off the top of my head.
And why is that? So that it's why do they do that? So that it's not
sure.
so.
I don't know. I think I remember when we got Google, we were the specialist in Google options, and that stock came out, and it took. It was a while, and back then it was probably there was different reasons. I think today it's a lot shorter that horizon from when an IPO happens and when you can start trading options. It might even be a few days. Now I'm going to look it up though, and we'll get back on that next time. I don't know the answer for today's markets.
And do you agree with Paulina? Is it good to wait when an IPO, wait a couple of months for IPO prices to level out?
Yeah, that. I think there's so much there's fervor around the IPO, right? Everyone's excited about it. So there tends to be, when you have that, you get a little bit of craziness in terms of people needing to get in and buy it and push it up artificially, blah, blah, blah. I think it's probably a good idea. What's the risk? The risk is everyone's really right. It is that exciting, the new IPO, and it's really going to scream and you miss out. So we've seen that happen before. The other one is everyone's driving this price up because they have to get in because they think they're going to miss, and then it comes back down. In which case, the advice is solid. I'm probably on the line of I don't want to be the first in the hopper. I want to let it settle, even if I miss it a little bit. That's okay. I'd rather let it settle. So I'm agreeing with Paulina.
Okay, and then question: so historically, do companies IPO together? Do they go public together? Do they, because that might benefit them in any way, in which case, if one is going, you can anticipate another going soon, and et cetera.
Wait, I don't understand that.
So you're saying, when you, when a company goes public, you can look to other companies to
I see.
kind of figure it. But do companies ever decide, even if they're in the same arena, that they're going to go public together because is there any synergy there?
Yeah, I don't know. I'd say no. I'd say probably not.
Okay.
I think the IPO game is a special one.
Isolatory.
Yeah, and they, it's special to them, and they want to knock it out all on their own. They want to be the only one.
What are components that you look at, before a company goes public that are signs that they're going to go public, aside from press releases and all that?
Yeah, we would never, we wouldn't know. We wouldn't look at any of the signs. I think, when companies raise a lot of money, right, then they start actually making a little money, right? They get beyond that early phase, and now they're actually profitable and generating decent revenue. Not necessarily profitable, but they're generating revenue. Man, they look to the public markets. People are selling their shares, right? And now they're raising massive amounts of capital in the public marketplace, right? So, Amazon, I think right around when they went public, this is a while ago now. I mean, they were never really profitable for the longest time, yet that stock just kept booming, right? And all of a sudden they became profitable, and now, it was kind of predictive, I guess. So they're fun. I enjoy them. I don't like trading options in the early going because I think, the market hasn't figured out where implied volatility should be. So you could get stuck with bad positions. And again, that's from the market maker side, not necessarily from the
equally, if you like excitement, you could probably get stuck. I mean, you could probably capitalize on undervalued, offerings. Yep, okay. And then I'm interested to see, in the digital age, crowdsourcing. How does that going to, because it's going to double. Some statistics say it's going to double in the next couple of years.
Crowdsourcing for these things?
Yeah, crowdsourcing and NFT and, all these brand new ways that will compete with going public.
Well, we had that, and we have that, and SPACs became slightly popular, and they disappeared.
Yes. Can you
I'm a
briefly?
traditionalist. I like the good old IPO, man.
I know.
All this other
I
stuff
know.
is wacky.
Like I still print out paper. If I'm reading an article, I still print it out. Don't tell anyone, but I do. I like it in my hand. I like a
I
book.
get my newspaper delivered still.
You do?
I do. Yeah.
Okay.
The problem with that is though, I don't read it for a week. So now the news is really old. So that's no good.
That's because you're a wine connoisseur. You like it to age a little bit.
Yeah, I've had some good wine in the last week.
Have you?
Been really good. Yeah.
Okay, give the world one. Give the world one.
I had a Scarecrow, and if you look that up, you'll see what that's all about. It's a little bit pricey, although I didn't pay for it, thankfully. It was a gift.
Okay.
But it was really good. Yeah, it's one of my favorites. Although I can't afford it; it's too expensive. All right, Ma, we gotta cut and run here on our lovely Friday. As always, good to see you and Paulina. We will pick this up again next week. And what we're going to start doing here is we're going to start talking about the week ahead on these Fridays. That's how we're going to end. But we're not doing it today because we haven't talked about it.
But tune in because the brew is now at 10 a.m. East Coast Standard Time.
Or 9 a.m. Central Time.
Central Time, right.
Right. No one talks about Central Time except for me. All right, Ma, we'll have a good weekend. I'll see you next week.